Imagine taking a $26 billion financial loss.
Which is just a staggering number on its own.
Right, but imagine taking that loss when your entire company is only worth $20 billion.
Yeah, the math on that it doesn't even sound real.
It really doesn't. But today, we're looking at a legacy automaker in absolute freefall and the digital disruptor that's, swooping in to pick its bones clean. Welcome to today's deep dive. We are unpacking this bizarre, super high-stakes collision between the digital and physical worlds playing out right now in early 2026.
We really are. We're looking at Carvana, a company that practically invented that frictionless, online-only car purchase, suddenly spending millions to buy a physical, old-school dirt and concrete from Stellantis.
And Stellantis, just for anyone who hasn't been tracking the corporate umbrella lately, is the heavy metal traditional giant behind legendary brands. We're talking Jeep, Ram, Chrysler, Fiat.
They're really big traditional players.
Exactly. So you have the ultimate digital disruptor buying the literal real estate of a struggling traditional manufacturer. And whether you're actively managing an investment portfolio or, maybe you're just looking to buy a truck this year, or you just want to understand how a massive global empire unravels in real time, there's a total masterclass in survival here.
Oh, absolutely.
So we're going to figure out what this corporate chess match means for the future of how you and I buy cars.
And to really grasp the sheer audacity of Carvana's real estate play here, we need to look at the crater Stellantis has left in the broader market first. Because the divergence we are seeing in the automotive industry right now is, it's unprecedented.
Let's wind the clock back slightly to understand that divergence, right? Because historically, the legacy big three General Motors, Ford, and Stellantis, they move like a school of fish.
Right, they were always in lockstep.
Yeah. If interest rates went up, they all took a hit. If supply chains snarled, they all slowed down. But looking at the market data from 2024 to early 2026, that pack has completely shattered.
The market has just ruthlessly decoupled them. And keep in mind, these are three companies with fundamentally identical business models.
Building heavy machinery.
Exactly. Building heavy machinery with unionized labor and selling it through franchised independent dealerships. Yet they are living in completely different financial universes today.
It's wild. Let's actually look at the scoreboard for a second. It's like watching three runners start a marathon at the exact same line, right? With the exact same shoes. And one gets a jetpack, that's General Motors. They effectively navigated their supply chain, dialed in their truck pricing, and their share price has more than doubled since 2024.
Which is a huge win for them.
Huge. Then you have Ford, who decided to go for a light jog. They pulled back early on some aggressive tech ambitions to protect their margins, and they're essentially a neutral, down a marginal 2%.
Right.
But then the third runner, Stellantis, trips and falls down a 70-foot ravine. They have crashed, a 70% drop, dragging their stock price down to around $6.50 a share.
And if we connect this to the bigger picture, this completely shatters the old illusion of the legacy moat.
The idea that they're too big to fail.
Exactly. For decades, the assumption in traditional manufacturing was that massive scale offered automatic protection. Like, if you had recognizable global brands and billions in revenue, you were simply too big to fall that quickly.
But that's clearly not true anymore.
Not at all. The market is proving that scale actually amplifies strategic missteps. When you are that big, a wrong turn doesn't just scrape the guardrail, It takes the whole convoy off the cliff.
Man. So if GM is doubling and Stellantis is down 70%, this isn't some unavoidable industry-wide recession. This is a Stellantis-specific catastrophe.
It's entirely self-inflicted.
Right. And because they're at the bottom of that ravine, the vultures are circling. Just last week, Carvana scooped up yet another Stellantis dealership.
Which is a massive pivot for a tech company. Carvana previously relied on a strictly online-only model, but now they're actively evolving into a hybrid model, blending their digital sales infrastructure with in-person brick-and-mortar retail locations.
They acquired 6 stores recently, right?
Yes, largely focused in the U.S. Southwest.
Wait, hold on. I need to stop and look at the irony here. Carvana built an empire on giant glowing glass vending machines specifically to kill the local neon-lit car lot.
Yes, they did.
Their entire consumer pitch was about never talking to a car salesman again.
Isn't this exactly like Amazon suddenly deciding to open up brick-and-mortar bookstores? Why on earth are they suddenly buying the exact same old-school car lots they spent a decade trying to destroy? What is the real play here?
What's fascinating here is it's the ultimate realization of market limits. Software eating the world is a great Silicon Valley pitch, but eventually software gets indigestion.
Carvana realized they had essentially maxed out the pure online consumer base. Millions of people adapted to buying a car from their couch, sure, but a vehicle is the second largest purchase most people make in their lives.
Yeah, there's a massive demographic of people who simply refuse to wire $30,000 without smelling the interior.
Exactly.
Or, kicking the tires and feeling how the brakes respond on an actual test drive.
Precisely. Carvana hit the ceiling of those tech-savvy early adopters. To keep their growth narrative alive for their own shareholders, they have to capture the traditional buyer. So they absolutely need physical footprints.
Oh, that makes sense.
And it's also a significant geographic expansion for them, considering their network has historically been really heavily concentrated on the East Coast.
And buying these specific physical dealerships gives them something a website just can't, right? A direct pipeline of physical inventory.
Yes, the trade-ins.
Because when a customer drives onto a lot to buy a new car, they usually leave their old one behind as a trade-in. So Carvana can take that local trade-in, refurbish it, certify it, and plug it right back into their national digital network, all while capturing the higher margin new vehicle sales happening right there on the lot.
It is a brilliant logistical maneuver. They are vertically integrating their used car supply chain and taking over an existing flat piece of asphalt with a showroom already built that is plug-and-play real estate compared to building their expensive vending machine towers.
But the choice of target is what makes this a really high-stakes game. They aren't buying thriving Toyota or Honda lots.
No, they're not.
They are specifically buying Stellantis real estate. They're acquiring the physical assets of a deeply distressed company, which implies Carvana is making a bet on a Stellantis turnaround, doesn't it?
It does imply that, yes.
They're buying low, assuming the underlying automaker will eventually get its act together and start producing vehicles people actually want to buy. But the question for anyone listening who manages their own portfolio is, should you follow Carvana's lead? Like, should an everyday investor try to catch this falling knife?
Well, catching this particular knife requires understanding just how deep the financial rod goes. The numbers coming out of Stellantis aren't just a quarterly earnings miss. They point to systemic operational failure.
Here's where it gets really interesting, and this brings us back to that mind-bending math fact I mentioned at the top of the deep dive. Late in 2025, Stellantis announced a $26 billion charge related to a massive adjustment in their electric vehicle strategy.
Historic write-down.
Yeah. But currently, Stellantis' entire market capitalization, the total value of all their outstanding stock combined, is hovering around $19 to $20 billion.
Right.
How is it physically possible for a company to take a $26 billion hit when the entire enterprise is only worth $20 billion? Isn't that a giant flashing red alarm?
It's the biggest red alarm you can find. We have to unpack the mechanics of a charge or a financial write-down here. Stellantis didn't write a literal cash check to someone for $26 billion.
Okay.
A charge is an accounting mechanism. It is the company legally admitting to its shareholders that the physical assets it holds, the massive new EV factories they built, the battery technology they invested in, the tooling on their assembly lines, all of it is worth $26 billion less than what the company previously claimed on its balance sheet.
Wow, so it's an admission of destroyed value.
Exactly.
They poured billions into an EV future, looked at the actual consumer demand, and had to confess, yeah, all that stuff we built, it's basically worthless compared to what we actually spent on it.
And when that admission of destroyed value is larger than the entire market cap of the company, the stock market is looking at Stellantis and saying, we have completely lost faith in your future earning potential.
Basically, you are worth less today than the mistakes you just admitted to making.
Precisely. The market is a forward-looking mechanism, and the future looks bleak.
And the operational mechanics back up that pessimism, too. The data shows their gross margins are sitting at negative 168%. I don't even know how you keep the lights on with that math.
A negative 168% gross margin is catastrophic. Gross margin is supposed to measure how efficiently you can build and sell a product before you even pay for corporate overhead.
So just the raw cost of making the cars.
Right. A negative margin that massive happens when you have enormous fixed costs like giant manufacturing plants and union labor contracts that you have to pay, regardless of whether the line is running at full speed and your sales volume completely evaporates.
So you're spending millions every single month to keep the factory heated and the workers paid, but only a handful of cars are rolling off the line and actually finding buyers.
Yes, the cost to produce each individual car skyrockets mathematically.
Which forces a massive cash bleed. I mean, this is why their stock dropped so violently and why management was forced to completely suspend their dividend.
And that suspended dividend creates a very dangerous trap for retail investors looking at the data right now. Oh, the classic ghost stat. Yes, the ghost stat. If you pull up Stellantis on a stock app right now, the data feed will likely show a dividend yield of around 11.87%.
Right, and to a novice investor, grabbing an almost 12% yield on a major global automaker looks like the bargain of the century.
But it's an illusion. Financial algorithms calculate that yield by taking the cash payouts from the past 12 months and dividing them by today's stock price.
Ah, so because the stock price has collapsed so dramatically, that historical payout looks artificially huge against the tiny new share price?
Exactly. But the company already turned the faucet off. That money is never arriving in your brokerage account. This emphasizes why critical thinking is absolutely essential in a world of information overload.
A dashboard stat without context is just bait.
Yes, you have to understand the mechanics underneath the number to survive in the market.
Don't fall for the ghost stat, everyone. So to understand the mechanics of why Stellantis was forced into that massive $26 billion write-down and those catastrophic negative margins, we really have to look under the hood of their portfolio. It's just a chaotic mess of brands and internal leadership struggles.
The corporate structure is a sprawling, fragmented nightmare. CEO Antonio Flosa is attempting to manage a portfolio of 14 distinct automotive brands across multiple continents.
Managing 14 different car brands feels inherently cannibalistic. You have the Detroit Heartbeat, Jeep, Ram, Dodge, Chrysler mashed together with the Italian flair of Fiat, Alfa Romeo, and Maserati.
It's too much.
It sounds like trying to conduct an orchestra where half the musicians are playing jazz
And the other half are playing heavy metal.
Right. Can they actually be fixed? Because I don't see how Filosa manages to feed the engineering budget for a new Jeep without starving Chrysler of the funds it desperately needs to stay relevant.
You hit on the exact mechanism of their decline. There is a total lack of global synergy. You cannot easily share chassis platforms or software architecture between a heavy-duty Ram pickup truck in Texas and a tiny Fiat city car in Rome.
It just doesn't work.
No. Every dollar spent trying to revive a stagnant European legacy brand is a dollar stolen from the American cash cows.
And the data from S&P Global Mobility illustrates the bleeding perfectly. From 2020 to 2025, Stellantis' global market share plummeted from 8.1% down to 6.1%.
And a 2% drop might sound small, but in the global auto market, that represents millions of unsold vehicles and billions in lost revenue.
It's massive.
And the most critical failure in that global bleed happened right here in North America. Historically, North America is the undisputed profit engine for Stellantis. High-margin vehicles like the Ram 1500 and the Jeep Grand Cherokee are supposed to print the money that funds the rest of the global operation.
But leadership made a series of catastrophic, self-inflicted wounds, didn't they?
They really did. They completely alienated their own dealership network and their core buyers. They pushed vehicle prices far beyond what the middle class could afford right as interest rates were spiking.
I mean, when you combine a $70,000 price tag for a Jeep with a 7 or 8% auto loan, the monthly payment becomes larger than a mortgage.
Consumers simply walked away, and the dealerships were left holding the bag.
And the mechanics of how dealers buy cars is exactly why this blew up, because dealerships don't just get their cars for free from the factory, right?
No, the industry term is floor plan financing. Independent dealerships take out massive short-term loans to buy the vehicles from Stellantis so they can park them on the showroom lot.
Okay.
When cars are selling fast, it's fine. But when Stellantis overprices their lineup and buyers disappear, the dealer is suddenly trapped paying crushing monthly interest on millions of dollars of stagnant metal sitting on their asphalt.
Wow. So it created open warfare between the corporate office and the showrooms. The dealers rebelled. They basically said, we aren't buying any more of your overpriced cars.
Exactly. And that instantly backed up the factories, leading directly to those negative 168% margins we discussed. The cash flow from North America didn't just slow down, it hit a brick wall.
So because those North American dealers are choking on unsold inventory, Stellantis is bleeding cash at an unprecedented rate.
And that cash bleed has forced leadership into a desperate corner, which is the catalyst for their latest massive gamble. They're essentially hitting the rewind button on the last 5 years of corporate strategy.
Yeah, let's talk about that because having just written off $26 billion on a failed electric vehicle push, Stellantis is now diverting roughly $13 billion of investment directly back into their North American operations.
The specific goal is to rapidly reintroduce more traditional gasoline-powered and hybrid models to recapture the market share they lost.
But wait, so what does this all mean for the future? I mean, if they're dumping $13 billion into gas and hybrids today in 2026, aren't they just putting a Band-Aid on a broken leg? Doesn't this put them incredibly far behind their rivals in the ultimate evolution toward electric vehicles?
This raises an important question, and the answer is it absolutely does. They are mortgaging their future competitiveness.
Wow.
But Stellantis is making a brutal existential calculation here. You cannot win the electric future of 2035 if you go bankrupt in 2026.
Oh man, that's dark.
They are trading future EV dominance for immediate sheer survival. They desperately need the cash flow that gasoline and hybrid vehicles provide right now because their EV lineup failed to generate it.
It is a literal fight for their life. And this dynamic loops us beautifully back to Carvana's overarching strategy, because Carvana's decision to scoop up those distressed Stellantis dealerships in the Southwest is incredibly shrewd when you view it through the lens of this $13 billion gamble.
Oh, absolutely. If the gamble works, if Stellantis actually manages to lower prices, fix their product mix with hybrids, and turn the North American business around, Carvana looks like a genius. They bought the underlying real estate and the franchise rights at the absolute bottom of the market.
But the true brilliance of Carvana's play is that Stellantis doesn't actually have to survive for Carvana to win, right?
That's the secret.
Yeah, Carvana bought the physical infrastructure and the zoning rights for a car dealership in a booming geographic region. Even if Stellantis completely collapses into bankruptcy and the Jeep and Ram brands are just sold off for parts, Carvana still owns that prime real estate.
And more importantly, they still secured that physical pipeline for local trade-ins and used cars to feed their massive digital network. They insulated themselves entirely from Stellantis' ultimate fate. Carvana wins either way.
They bought the dirt, not the corporate baggage.
Exactly.
So, distilling everything we've looked at today from the sources. While opportunity is clearly knocking for a giant, agile corporate entity like Carvana to scavenge assets and build out a physical footprint, the verdict for the everyday investor is starkly different.
Very different.
When it comes to Stellantis with their tumbling stock, their massive negative margins, their cannibalistic 14-brand portfolio, and all their internal confusion, it is best to leave the door securely closed for now.
I agree. Let the giant corporations with billions in capital play the high-stakes restructuring game. For the individual investor or even the consumer wondering if their new truck's warranty will be honored in 5 years, the structural risks in Stellantis currently outweigh any potential rewards. The broader lesson here is about focus versus fragmentation and having the humility to change your business model when the market tells you you're wrong.
Which brings us back to where we started. We often assume that innovation is a straight line, right? That the sleek digital world will eventually conquer the messy physical one entirely. But I want to leave you with a final thought to mull over as you go about your day. If a revolutionary digital-first company like Carvana, a company that practically invented the modern, weightless online car buying experience, eventually realizes that it must buy physical, oily, old-school dirt and concrete just to survive and grow, what does that tell us about the ultimate limits of the purely digital economy?
It really suggests that no matter how sophisticated the software gets, you can't live in the cloud forever. Eventually, the rubber has to meet the road.
Literally. The future of tech might just be a humbling return to the physical world. Thank you so much for joining us on this deep dive. Whether you are running a small business, managing your household budget, or just trying to make sense of a chaotic market, we love unpacking these massive shifts with you. Stay curious, remember to always look past the ghost stats, and we will catch you on the next one.